Hello everyone and welcome to our YouTube channel Finbuzz Learning. Today we are going to discuss about corporate finance and know the importance of finance in the corporate world and in which areas are involved in it. According to famous American economist and Nobel laureate Martin Howard Miller, if you take money out of your left pocket and put it in your right pocket, you are no richer. To beat the market, you will have to invest serious bucks to dig up information no one else has yet. Generally, the corporate finance is also called as business finance, in which the corporate has to arrange finance for the company. The primary goal of corporate finance is to maximize or enhance shareholder value. Corporate finance is directly concerned with the company decisions that have a financial or monetary impact. It can be considered as a link between the capital market and the organization. It helps a company financial health and growth also. The corporate finance officer is the main building block of the corporate world. The CFO is the most important corporate executive after the CEO. But in today's business environment, the CFO faces new challenges. Corporate finance surveys the market and suggests product based on new demand. It also helps in research and development. The use of the term corporate finance varies greatly around the world. In the United States, it is used to describe analytical methods and techniques. In Commonwealth countries, the term corporate finance and corporate financial are associated with investment banking, that is, with transactions in which capital is raised for a corporation. So what are the areas in corporate finance? If we see, finance is mainly divided into three parts: public finance, corporate finance, and private finance. Since we are talking about corporate finance, it is important to know what are the areas in corporate finance that an investor focuses on. It is divided into three parts: capital investment, financing capital, and short-term capital. First of all, we will talk about capital investment. It is a long-term investment in which it is decided in which areas of a business money can be made. Through this, a company identifies capital expenditures and compares planned investment with potential earnings and decide which products to include in its capital budget. The second is capital financing. It is determined by how long-term financing a capital needs. It is also responsible for raising capital in the form of debt or equity. A company may borrow from commercial banks and other financial intermediaries or issue debt securities in the capital market through investment banks. But having too much debt can increase default risk, and relying heavily on equity can reduce earnings and value for early investors. And last one is short-term capital. It's a company credit card that pays for near-term expenses. Its especially things is that compared to other loans, its installments are repaid quickly. Short-term financial management deals with current assets and current liabilities or working capital and cash flow. If there is delay, the company has to fulfill all its obligation related to it. But doing this, there is no hindrance in the operation of the company. This involves obtaining additional credit and commercial paper as a backup. Why is it required? Friends, corporate finance is very essential in today's time. We are saying this because in today's world, almost every person is playing the role of an investor in the company or start a business in some way. Corporate finance is concerned with how to provide funds for maximum profit with minimum cost. It relates day-to-day operation with cash flow and long-term goals. It also includes functions such as accounting and preparation of financial statements. It helps the business firms in business-related decision making. So thank you for watching our video. Hope this will help you to understand the today's topic. Please like, share, comment and subscribe to our YouTube channel Finbuzz Learning. Thank you.